Both the S&P and NASDAQ are at 52-week highs. It's been quite a ride for this year. On Saturday night, the U.S. bombed Iran's nuclear facilities. And by Monday night, President Trump declared a ceasefire. In stablecoin world, Circle went public. MasterCard teamed up with Fiserv to create a stablecoin. And that is big competition for the likes of Circle and Tether. I believe that the U.S. economy is more dynamic than at any time in my lifetime. So what could derail it? I think only one thing. Hi, this is Steve Eisman, and welcome to another edition of the Weekly Wrap. But first, some housekeeping issues. If you've been listening to the Eisman Playbook, please note the show is now called The Real Eisman Playbook on Apple Podcasts and most other platforms. Spotify subscribers will automatically move to the news show, so you don't need to do anything there. But if you listen on Apple Podcasts or any other app, please search for The Real Eisman Playbook and resubscribe to keep getting new episodes. Thanks for your support, and see you on the new channel. And first, the stats. For the week, the S&P 500 was up around 3%, and NASDAQ was up around 4%. And for the year, both the S&P and NASDAQ are both up 5% roughly. In fact, at the end of Friday today, both the S&P and NASDAQ are at 52-week highs. It's been quite a ride for this year. And let's review that ride for a bit. Both indices rallied at the beginning of the year and reached all-time highs in February, and then corrected sharply until April 8th on fears of tariffs and a potential trade war. And then rallied hard, so that as the end of today, both the S&P and NASDAQ, as I said, are at all-time highs. Why? It's always hard to explain why the market does what it does, but here's my explanation. First, like I've said before, markets tend to price in the ultimate end result immediately and then see what happens, especially when the news flow changes abruptly. So when President Trump began to pound the table about tariffs, markets not only began pricing in tariffs, but a full-blown trade war and a recession. And here is the key. They irrationally expected the tariff news to hit the economy immediately. Then, when companies reported earnings for the first quarter in April and May, and the earnings that were reported were mostly fine, everyone realized that a recession was not on the horizon, at least not yet. And so we rallied. But there's something else. This is the second point. NVIDIA reported at the end of May, and here, a $3 trillion market cap company, which is now the largest company in the S&P, reported first quarter year-over-year revenue growth. I repeat, revenue growth of 69% year-over-year. Incredible, astonishing. And it proves that the AI story is still in its infancy. Which brings me to my final point. There are 11 sectors in the S&P. Infotech is the biggest at 31%. But when you add in companies that are not officially in infotech, but are thought of as tech, like Google, Meta, Amazon, and some others, then tech and tech-related is over 40% of the U.S. market. No other country is even close to that level. I believe that the U.S. economy is more dynamic than at any time in my lifetime. And I think that that idea is starting to seep into the market. So what could derail it? I think only one thing. A trade war. And while the tariff news of late has been benign, trade negotiations are complicated and anything could happen. Treasury Secretary Bessent said today that he thinks the trade negotiations with most countries will wrap up one way or another by September 1st. But later in the day, President Trump announced that he was breaking off all negotiations with Canada because Canada had imposed a digital service tax on U.S. tech companies. And over the weekend, he was going to decide what retaliatory tariffs he would impose. Reminds me of what Michael Corleone said in Godfather Part 3. Just when I was out, they dragged me back in. And so now for the week itself. The week began before the week began. On Saturday night, the U.S. bombed Iran's nuclear facilities, and by Monday night, President Trump declared a ceasefire between Iran and Israel and the United States. To give you an idea how volatile things were, on Saturday night, Brent oil had an $8 handle on it, meaning it was in the 80s. By Tuesday morning, it was below $70 and ended Friday there as well in the 60s. Energy stocks suffered as well. There was a little bit of earnings news. Carnival Cruise shares soared on Tuesday after reporting better than expected earnings. The company reported 35 cents a share versus the consensus of 25 cents. It also beat revenue estimates. More importantly, it raised its earnings guidance for 2025 to 40% growth versus 2024 versus the prior 30% growth that they had estimated. All cruise stocks rallied. Cruise remains an interesting area for travel. Post-COVID, the price of a hotel room has soared all over the world. But because of overcapacity, cruise prices barely grew. So cruise is a much more enticing choice for consumers because of the lagging price. The other interesting earnings report was Nike, which reported Thursday night. Nike has been in turnaround mode for quite a while and has a new CEO for less than a year. The company's fourth quarter was an EPS beat, but fundamentals were certainly not great. Sales were down, and the company guided the next quarter to below the current consensus. Now, normally, a stock would likely go down on this type of news, but the company spoke on its conference call to several green shoots within its portfolio, so the stock rallied around 15% on Friday. Just to review some history, Nike reached an all-time peak of $180 at the end of 2021 and has gone down ever since. After today's rally, the stock closed in the 70s, which is where it was in 2018. But clearly some investors are hoping here that a turnaround is about to happen, so we shall see. In New York City, the Democratic primary was won by Zoran Mamdani, an avowed socialist. He will probably become mayor in the November election. The New York City mayor has limited power over taxation, but has the ability to change real estate taxes. As a result, companies with real estate exposure to New York like Vornado, SL Green, and Flagstar Bank saw a correction in their stock prices. In stablecoin world, Circle went public only on June 4th at $31 a share and reached a peak of $260 at the beginning of the week. It closed this week in the 180s and has a market cap in the low 40 billions and is valued at around 80 times current 2026 EPS estimates. But competition is entering the stablecoin space. But before I get to that, let me review some things about stablecoin. If you want to learn more, my podcast a few weeks ago with Raul Jindal of Autonomous Research discusses stablecoins at length. So what's a stablecoin? It's not a cryptocurrency, but it uses the same underlying technology. So let me explain what it is. If you buy a stablecoin through a Circle or a Tether, let's say you buy $1,000 worth of stablecoins. You pay Tether or Circle $1,000 and you get $1,000 worth of stablecoin. Tether and Circle will then take your money and buy US treasuries, so the money is safe, and your stablecoin is linked to the dollar for dollar. So what is a stablecoin good for? It's a method of payment. But I would point out that you need a network to transfer the money. So for example, let's say you want to pay someone in stablecoin. You have to go onto a network, whether it's a Tether network or a Circle network, and transfer the money to the person that you're buying the product from. And that is key. You must use a network to transfer the stablecoin money. Now, the news of the week is that MasterCard teamed up with Fiserv to create a stablecoin, and that is big competition for the likes of Circle and Tether. MasterCard already has a global network and is more trusted than newcomer Circle, and I am sure that Visa will do something similar. So we shall see how stablecoins develop, but competition is heating up. And let me just end here with a few more words on stablecoin competition. Since the creation of Amazon, many sectors have undergone rapid change with upstarts like Netflix or Tesla taking market share from incumbents. And I'm sure that the fans of Circle believe something similar here. Yes, I know that new companies tend to conquer in the digital age. Again, Amazon and Netflix as examples. But here we are talking about Visa and MasterCard, formidable competitors. And every few years, it's been my experience that there are potential replacements who show up and argue that they are going to disintermediate Visa and MasterCard. But Visa and MasterCard already have global networks that are trusted. So I think for the stablecoin newcomers to do well, they will have to create incentives. So it's going to be very hard for the newcomers, I believe, to disintermediate Visa and MasterCard in the payment system. But in the area of remittances, where you send money to someone overseas via Western Union, I think that's a much easier market for the stable coins of the world to break through. Stay tuned. And that is the week. And now for the mailbag. But before I even talk about the comments that I got this week, let me just say that if you want to make comments about our podcast on YouTube, there's a comment section. You can leave a comment there. Or if you want to just send me an email directly, send an email to info@steveeisman.com. And now for the mailbag. I want to talk about two comments. The first is from @TomSchmo, who says, like most anything, capitalism has the potential to create negative externalities for society. Proper regulation seems obvious and essential, but implementing it is up against the people who benefit in the process of creating those negative externalities. I'm more pessimistic on this with every passing year, but at least you tried to get the word out. So this comment is in reference to my podcast that I put out Monday with John Cassidy, who wrote the book, Capitalism and Its Critics. And we had a wonderful conversation, but let me address this comment. What this viewer is discussing is what is called captive regulators. And what history has shown is that when there's a problem in capitalism, eventually the government tries to address it by creating some sort of regulatory body. And the problem becomes over time is that the experts that the regulators need to consult to regulate an industry are in fact the industry itself. And over time, the regulators become captured by the industry and the efficaciousness of regulations deteriorates. I think that's a very fair criticism. I wouldn't be quite as negative as this comment makes it out to be. Things tend to go in waves. If you look at the financial services industry, for example, there is no question in my mind that prior to the financial crisis, the bank regulators were as captured could be. And that was one of the reasons for the crisis. They just let the banks get away with murder. But post-crisis, teeth was put into the regulatory bodies. The regulators are quite tough, and that will probably last a long time. Even under this Trump administration, which is talking about being somewhat more benign towards the banks, we're not going anywhere close back to where we were prior to 2008. But this comment does raise a very important issue. And lastly, the last comment is from @iCloudHurry007, who says, I'd love to hear your thoughts on when markets are fearful, be greedy. How do you think about the overall market in contrast to how you might think about your approach when multiple legitimate fear factors are at play? It's a great comment. A couple of thoughts here. We've been in a bull market pretty much for the last 10 years with some fits and starts. And so buy the dip has become almost a religion. It's a religion that I right now largely subscribe to because I am of the view, again, which is what I said earlier in this weekly wrap, that the U.S. economy is more dynamic than it's ever been in my lifetime. So long term, I am very bullish. However, the one thing that I worry about is a potential trade war. And here, it's in no one's interest for there to be a trade war. But just like in World War I, it was in no one's interest for there to be a World War I. But because of the reciprocal treaties that countries had, they fell into it. I think it's still possible that there's a trade war. I don't know how to handicap it. That is really the only risk in the market. As long as there's no trade war, I'd buy every single dip. If there is a trade war, however, you would see a very big correction, I think, in the market. And that's the week. On Monday, we're going to drop a very interesting podcast of a panel of myself with 3 financial services analysts discussing CEOs. Who's good, who's bad, and why. Hope you can tune in. Have a great weekend. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.